to BizRadio1. I'm your host, Jeff Snell. I'm founder and principal broker of Inline Business Brokers, bringing you up-to-the-minute information about everything that matters to you when buying or selling a business. Today I have with me Steve Mariani, the founder of Diamond Financial Services. Today's an impromptu conversation about some chatter we started hearing yesterday on social media platforms about a change in the Small Business Administration standard operating procedures. Specifically, Clint Fiore interpreted that the new SBA SOP would allow a single individual to have multiple SBA guarantee loans, each with their own $5 million cap, but cannot have the same three NAICS code designations. Steve, I understand that you were on a National Small Business Administration call today. I know that you're on the Finance Committee. What did you hear about this?
Yes, absolutely. You're correct, Jeff. And this rule actually went into effect by default. That's not what their intention was, but it is the result. So Clint is right. You could, in theory, have two businesses at $5 million with different NAICS codes. What I did bring to the attention of the NSBA today was, and I was talking to their top level SBA professional who lobbies Congress, was in the hearings and everything on all these changes. They're very excited about what we discussed this morning. And I can also enlighten everybody about the lender feedback that I've gotten on this rule. And maybe I should back up a little bit. The attention has been on all the other additional rules, and there hasn't been a lot of lender chatter about this rule per se in the last couple of weeks or months, even that's going. So it's been kind of put on the back burner. It is starting to surface now because everything else has kind of been settling down. So what I was able to do today was actually talk to a few lenders and get their opinion on this as they're starting to interpret this rule, which is always the first step. Once a new rule comes out, it's about interpretation and how the lenders are understanding the rule and what they think is eligible. But you're exactly right.
As we've seen many times over the last 20 years working together, the intent of the SOP and the practical application and the interpretation are rarely aligned. So as you view it and the lenders that you've had an opportunity to talk with over the last 24 hours view it, does this limit the SBA approving a guarantee to a commercial lender for a buyer to two? Or is it unlimited so long as the first three NAICS code designations are different?
We're not seeing it as it limits it to two. If they're an unaffiliated business with those first three digits different from the first one, we're seeing this as it's not two. It could be three. It could be four. It could be five with different NAICS codes. The big concern is going to be on the lender side, and exactly. There were items that popped up in my conversations, which I'm happy to describe.
So from a practical perspective, the majority of lenders, the top SBA lenders, what do you think their ultimate interpretation is going to be on the practical limit? Because let's be realistic. No commercial lender is going to seek an SBA guarantee for the 20th $5 million acquisition that a single individual is going for. Where do you think that threshold is?
That's exactly right, Jeff. Most lenders, no matter internal or external as far as their loans go, have a per person limit that they'll be exposed to, and that's the portion that's not guaranteed by the government. And that's really what drives lenders. So if you think about that, a single $5 million transaction, the lender's exposed for about $1,250,000 themselves. Right. If they were to write that same individual a second one, now we're talking about $2.5 million writing on one individual's business capabilities.
Assuming that both of those went into default.
Right. Whether they default or not, their exposure is there. They're going to have $2.5 million of unguaranteed money on that one single individual. And that's really what lights up their red lights at their risk tolerance departments. That's always their concern. So the lenders that I've spoken to, and I actually did put out some feelers to find out, will any lender that I know do this? Because the initial ones we're not going to go over $5 million. Most of the lenders these days, especially if you're in the acquisition world, don't even want to write $5 million. Most of them want to stop between 2 and 3 million someplace as far as their individual exposure on a loan maximum. So getting them to 5, I'm limited to lenders already. Okay, but there are lenders that will do 5 million. To get that same aggressive lender to go to 10, it's not going to happen. So I did poll lenders today, multiple, and even asked them to poll their friends, because we have a little circle of lenders that we discuss things. And it's really about interpretation. Everyone wants to understand how everyone else is interpreting it. The most aggressive lender we found said With a second NIASA code, if everything is stellar, we would go to a maximum of another 3.5 million. That was encouraging. Yeah, I was pretty impressed to hear that. Now, that said, they don't know the industries, they don't know anything. But things to consider, which is what all the other lenders brought up, was that borrower was going to be long out of collateral because everything he did have was taken on the first $5 million loan. The second loan also, he's going to probably be scraping up the down payment because if he's got a $5 million first loan, it's not that old. If that was paid down to 3.5, maybe we're years down. But it's going to be the lack of collateral. And then what you're throwing on top of everything else based on the SBA SOPs is he has to have no experience in that NIASA code and industry, which is the third biggest issue for lenders.
Yeah, you mentioned something that I wanted to touch on explicitly, and that is something most business buyers and sellers don't know, and probably some business brokers aren't even aware of, is that the SBA $5 million cap historically is per person. But if in theory or example, somebody had a $6 million acquisition, they did $1 million down payment, they had a $5 million conventional loan with an SBA guarantee of 75%. As time passes, the principal on that $5 million decreases. Most people don't know or are not aware of the fact that SBA $5 million becomes available to them again for a subsequent transaction. So if you've paid 50% of your principal on a $5 million initial loan, the same $2.5 million available to you from the SBA guarantee perspective for another transaction or a recapitalization or whatever the legitimate need may be.
That's exactly right. It's aggregate total of 5 million at any given time. We have some clientele we've written 3-4 loans for to get to that 5 million. We have some that we've written 1 loan for, but as an ongoing aggregate. You're correct when you say as they pay it down, it frees up additional funds.
So let's pivot the conversation a little bit at this point. When we spoke this morning, I was advocating for a increase of the SBA loan maximum of $5 million to $10 million. And my thesis or my premise for that argument was the last time the SBA adjusted the cap, which is currently 5 million, was in 2010. And they adjusted it from 2 million to 5 million. So that's a pretty big jump, over 100%, obviously, 150% if we want to be specific. So 14 years fast forward to 2024, we've had no adjustment to the $5 million cap. I was proposing a $10 million cap, and really to forgo this NAICS multiple loans per individual, very complicated, very convoluted to interpret and put into practice. What, if anything, did you hear from lenders or national SBA board members if that came up?
There's no downside to that. What they're offering now is you can borrow another second $5 million in a completely unrelated industry. Well, if we're going to do that, the point you made this morning, which was, well, why wouldn't you give that to them for their same industry and let them expand in the industry that they're already successful in? And to be honest with you, as a lender, and I explore the rules every day, that hadn't occurred to me. But we, like I said, are just now talking about this second 5 million availability. That was a great point. So as the second district council member for the NSBA, which is the National Leadership Association, we represent 65,000 businesses. And I brought that up on our call, which had over almost 250 leaders on it. They were all over it. I spoke with the top SBA guy there who understands the program really well, who sat in on the SBA hearings, and him and the other leadership council top people are going to get up with me, and we're going to start working on that, because that was an excellent suggestion. Because like I said, by default, the rules allow a borrower to get 10 million. Well, why would you discriminate against somebody in the same industry looking to expand his business?
Exactly.
So, yeah.
So earlier in the podcast, you mentioned that the most aggressive lender that you had spoken to about this SOP change to multiple $5 million caps was only willing to extend to 3.5. What do you think the practical application would be if the SBA raised the cap from 5 to 10? Do you think they would be equally conservative and only expose themselves to 8.5 million of a potential 10? Or because it had been embodied in SOP at 10 million, do you think they'd just look at that the way they looked at it when the cap went from 2 million to 5 million?
Here's what I would think. And now I'm putting my lender hat on and I'm putting my underwriter hat on and saying, okay, how am I going to feel about this individual? First of all, if he's been in the industry and we're just doing an expansion of 5 million, I'm going to be a lot more comfortable. If he's been running the operation for 3 years and has a $4 million still outstanding balance and is looking to buy another $4 or $5 million acquisition, we're going to have a track record there. His history means everything as far as I'm concerned. And again, I'm wearing my underwriter hat. I've seen Jeff Snell be successful for 4 consecutive years. Guess what? I want to help him continue to grow because I know he's just going to do great things. There again. Now, if Jeff's coming to me with a brand new $9 million acquisition, am I going to put him a little bit more under a microscope? I'm going to have that same exposure. But now I'm also looking at, well, now if you're looking at a $9 million acquisition, you're not going to have 40,000 equity in a house. You're not going to be scraping up the down payment to barely make it happen. You're going to be a stronger individual. So maybe you are bringing $1.5 million of house to the table, or collateral, I should say, whatever form it's in. And then same thing with the $9 million transaction. There might be some collateral there, but we're going to look at the big picture just like we would a 3, 4, or $5 million acquisition. And it's going to be the strength of the overall transaction. But I would think it's going to be a lot stronger deal with your resume. It's going to be a lot more wiggle room on the cash flow. Let's face it. 9 million is going to make some higher SDEs.
Yeah, well, definitely the third leg of the stool, cash flow and experience, is size. We talked this morning about how the buy versus build question is answered by most sophisticated business buyers as a buy and not a build, because the risk of startups, I think you quoted a 76% failure rate within the first 24 months. Well, we have nowhere near that default rate on business acquisitions with SBA guarantees. Otherwise, the program wouldn't exist and nobody would be able to buy or sell a business. But let's start winding down by talking about the alternative SBA loan program at the low dollar range, what impact you feel that may have on the overall SBA program, and then provide a little bit of commentary on why do you think that the SBA is focused on giving low-level loans to inexperienced individuals to start up businesses that statistically are going to fail, rather than further supporting existing business owners that are doing add-ons or recapitalizations, or in this new SOP program, acquiring unrelated NAICS types of businesses that have a proven track record in cash flow?
I won't go too far down this road because this is already being argued in front of Congress and the Small Business Committee in Texas. But ultimately, the administration handed this down and issued 3 SBA licenses to fintechs, which are algorithm-driven loan sources. Those fintechs were also licensed during the PPP and produced the highest level of defaults on PPP and fraud. But yet the administration still found it in their wheelhouse to approve them to write 7A loans. Now, their argument at Congress was because lower served communities struggle to get financing, okay, and they're underserved by our SBA departments. So they're encouraging $25,000 to $100,000 transactions be approved within 3 days, all via algorithm driven. And that's a concern for real lenders as far as the defaults have got to increase, just like they did when they let them do PPP loans.
Yeah, I don't want to get political, and I know you don't want to get political, but I would have to argue that the reason that by definition they are underserved is because they're subject to the same underwriting guidelines and they simply don't meet those guidelines. So there may be a little wordplay going on there as far as the political commentary at the congressional level and whatnot. But long term, I think we need to protect the SBA program in general. But we also know that the PPP program had some of the highest fraud in any government program in history. So I find it disturbing at minimum that we're putting the entire SBA program for what we call traditional lending and traditional underwriting and guarantees at risk for what seems like, I can honestly not come up with another phrase, but a fool's errand in giving $25,000 to $100,000 to people that don't have business experience, that are then going to face all the struggles and challenges of a startup that statistically we know when people are using their own money, still fail at a rate of 76% over the first 24 months. So we've hit on a lot of stuff in this short period of time. I hope that everybody listening found it beneficial. If you've got questions or comments, please put them in the comments, and Steve or I or both will be happy to respond. I look forward to bringing you more BizRadio1 content. And again, I hope this was very helpful. Thank you, Steve, for your time and experience. I know I appreciate it, and I think everybody who's had an opportunity to participate does as well.
Well, thanks for having me, Jeff. This is important information I am happy to share. This is a great service getting this information out there because people need to know and be aware of this stuff. And like Jeff mentioned, we're always available. Reach out to us at any time if you have any questions on anything we discussed or anything we can help with.
Yeah, it's constantly changing as well. So we look forward to seeing you again. Thanks, everyone.